From the morning reading, the indices pause on Friday while the spiders, diamonds, and Qs make new weekly high close. 3 of 9 sectors moved higher on Thursday. XLE, XLP, and XLU were the strongest sectors, while XLB was the weakest sector. Oil futures rose $1.23 to close at $44.69. All 9 sectors continue to be year-to-date positive after all 9 sectors had turned year-to-date positive for the first time a week ago. On the S&P 500 snapshot, a fractional Friday loss, but a tiny weekly gain. Thursday's record close was followed by a muted Friday. The pre-market open economic news was weak, most notably the disappointing July retail sales. The S&P 500 opened lower, recovered to its minuscule 0.02% intraday high, and then sold off to its 0.29% intraday low at the end of the lunch hour. A partial afternoon recovery trimmed the loss to negative 0.08%, which tallied to a lackluster weekly gain of 0.05%. Treasuries rallied on the retail sales disappointment. The closing yield on the 10-year note rose. The closing yield on the 10-year note fell 6 basis points to 1.51%. Also in the morning reading, stocks don't get much less volatile than this. The past month has seen an extraordinary compression in the movement of the S&P, which is coiled into one of its tightest range in history. When the index has moved to new high with such little movement, the next couple of weeks have been rough. Twitter users have been anticipating a breakdown. Social sentiment on the most active ETF in the world, the SPY, has been pessimistic for much of the past month as volatility declined. The only time in the past 4 years that it has been more pessimistic was in September 2015 as stocks were bottoming. Another flood of money goes into the junior gold miners. There's been an inflow into the junior gold miner fund, GDXJ, for the past 2 months, and it has picked up this week, with nearly $200 million coming into this fund. ETF fund flows can be inconsistent indicators, but they've been a decent contrary guide in GDXJ. When we see a big weekly flow like this, after the flow has already been strong, it suggests exhaustive buying interest and should be a minor negative for the fund in the short to medium term. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:23 a.m. Mountain Time, and I'm recording this in preparation for the market day of August the 15th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And at the time of this cut, all 4 of the broad market indices for the U.S. were slightly up, and basically just above scratch, none of them exceeding 0.25% increase. Crude oil was also up just above scratch, is the euro. And for that matter, it's a perfect sweep of all 8. The bonds and gold all also up just above scratch. Not quite the same picture in the overseas. China up 2.44%. Hong Kong up about 0.75%. Japan down about 0.33%. Germany up almost 0.5%. United Kingdom up about 0.33%. We do have some bank holidays in Europe today, so that could lead to some reduced trading activity. So be mindful of that. In the United States, we do have a couple important reports: the Empire State Manufacturing Index and a couple yellow flag reports. And looking forward to tomorrow, we have building permits, CPI, housing starts, capacity utilization rate, industrial production. So a number of key reports there. So pretty good Tuesday slate. So perhaps just a bit more activity on the front end of the week than we sometimes have. In terms of current volatility, obviously we've been talking about how compressed things are. One of the morning authors was talking about the compression and the low volatility. Short-term VIX right now 9.52. You see the skew slightly elevated at a 132. IV percentiles just about bottomed out in terms of where we are as percentiles. 0 on the S&P, Russell at 2, NASDAQ a 0, the Dow a 1. No standard deviation moves were put in on any of the 4 U.S. broad market indices on Friday. And indeed, if we go to the charts, you're going to see that Friday's action was pretty much doji material. And that would be this candle right here. Though you will notice, while small range, so far the Globex activity from Sunday night into this morning has been pushing up, and we have put in an intraday new record high. So it's pretty modest though, so we won't get too excited about it, but still, it is a bullish move to start the day. In terms of the Dow had a little bit larger body on Friday. I know it was negative, but still nothing terribly noted. And frankly, it's already been absorbed in terms of the overnight move from last night. Now has us back up near its all-time high activity of Thursday. In terms of the NASDAQ also has set up a new intraday high sometime last night, this morning. And then the Russell also moving towards its prior high. So really fairly bullish action, though small range, on all 4 of the broad market indices. Perhaps of more interest, let's take a look at the VIX here. And you note that we've spent some period of time down here now, and really you probably have to go back to last summer to be able to see an extended period where volatility was so low and persistent. So obviously at some point you start to rattle that action and you get an expansion kind of like you had here last August. And of course we're coming up right at the annual anniversary of the big spike in volatility from last August. We went all the way, and you note here, see, one day you're at a 12.86, and then 1, 2, 3, 4 days later you're up here at a 53. So that's why I talk about these very low volatilities as a potential area of risk, because from these very low volatilities, we often have the expansion of volatility, and it can come very fast and hard. The problem with that, for a timing perspective, is that we can persist, as we have here, for weeks with this low volatility. So you have to watch for those signs of change and then the rate of accelerating change to be able to pick up on when these things are, truly doing something of significance. So right now, not much to get excited about, but it's out there, it's looming out there. It's on the horizon, much like calm before that hurricane comes ashore. It's going to start increasing, and watch for that increase in volatility to start ticking up. In terms of some of the other markets, crude oil. You see crude oil has put in a higher high, a higher low, and now another higher high. So the intermediate term posture, while still below the cloud and dealing with a lot of overhead resistance, the shorter term pattern has turned bullish. So you kind of got mixed directions going here, with the short term pattern bullish, the intermediate term pattern that perhaps you could call as bearish, especially since this was a pretty significant breakdown from this wedge pattern and below the cloud. But then the longer term pattern, and you could argue as to whether this is the intermediate term pattern or this is the intermediate term pattern. We normally think of intermediate term as in days to weeks, and this represents quite a few weeks here. But then that was preceded by months worth of very strong bullish pattern. So it's kind of a mess right now on the multiple time frame analysis with crude oil. But depending on what time frame you're trading and looking at this, you'd have to say at least the shorter term patterns are bullish and starting to recover some of this action. This has potential to affect the certainly the broader market if it's seen that the economy is improving and there's increased demand, and that's why crude oil is going up. The economy will happily absorb some of that as long as it's not too hard, too fast. At the same time, if crude oil starts to really break and starts to become, in quotes, expensive again in relative terms, that could put a dampener on the economy. So it's definitely one of those sweet spot kinds of situations. In terms of gold, let's take a look at gold, and then we'll look at bonds to see where the safe haven statuses are going. We've had this triangle, and we kind of tickled the edge of the triangle. I'm not going to call that a decisive break. We closed just outside the candle. In fact, when I saw that, I went back and took a look. It's like, do I need to redraw my line? Did I have it accurate? And I'm pretty happy, frankly, with how I've drawn that line. And so I think this was indeed a close. It just wiggled out of the triangle pattern. We're getting close to the apex. Something's going to have to happen. But let's put this in context. This is gold. We have talked repeatedly this year about how sloppy gold has been with its technical patterns. And oftentimes when we think something's going to happen, it doesn't. Or it breaks down. And for example, here we had a triangle. It did break up as we expected, just to invalidate the whole thing, undercut its lows, and then turn bullish again and take off back up and set up a new 52-week high. So it's been a sloppy chart with the gold futures. So we've got to kind of keep that in mind. This may, when we look back at this 3-4 weeks from now, be an insignificant event in the bigger picture. But that continues to remind us that as we set up gold trades, we've got to do it with the mind of patience, because these things, while ultimately repeatedly resolving to the bullish side in recent months, have often kind of tried our tolerances. And if you're using stops, this is a tough market to use any kind of stops with before it finally does do what we thought it should do all along. Let's go ahead and take a look at bonds. The bond's still in that sideways consolidation pattern. I don't see anything here really to get us terribly excited about. The only thing is that, given the pattern coming into this and the support that we have underneath this, I would expect that it would eventually break out to the long side. And that may very well line up with, who knows, chicken and egg, but it may very well line up with the equities starting finally to have something of a retracement. Remember, the equities are a bit exhausted. At some point they're likely going to kind of test and try to find where that support is and give us something of a pullback retracement. And so that bonds would move up, gold would move up, the VIX would finally, come off of its daily squeeze, and the equity market would turn down. It would all make perfect sense, and we would see all these things kind of resolve themselves in the directions that, in short term would be expected. Now, I would expect that equities continue to set up bullish patterns, and that the bearish retracement would be just that, a retracement, a short leg down to set up, frankly, for the next leg up. Let's see, what else do we need to have here? We got bonds, gold, crude. Yeah, I think we're okay on the charts. Let's go ahead and move forward. And off to the daily report. So in terms of our top of the daily report, obviously we look at the kind of big picture and the market timing signals and so forth, and where are we with the intermediate term phase opinion. Right now we continue to think we're in phase 3, which is bull flags. These may be regular bull flags or horizontal bull flags. We've had a couple of those in recent weeks, but basically looking for a series of these minor retracements with longer bullish legs. In terms of the market timing signals, fairly bullish, but we do have some kind of sticky wickets, as it were. The first mechanical signal comes to us from IBD, confirmed uptrend, that's bullish. GMI index slid a notch to a 5 out of 6, but still bullish with the buy signal in place since 7-1. The GMI 2, the more sensitive one, is actually still 8 out of 8. In terms of stock charts decision point scoreboard, our third mechanical signal for market timing, this is where we get some additional detail, and frankly, it's where we also see from that additional detail some additional kind of conflicting signals, especially in the short term and long term. You see multiple pair clusters here that are in contrary directions, and then in the long term also multiple pair clusters that are in contrary directions. So very conflicted market timing signals coming to us at this point from stock charts decision point. And that, frankly, isn't surprising given that while we've been setting new highs, they've been very modest incremental new highs, and we've been largely, from an indicator standpoint, looking more sideways than, strongly bullish. Now, in terms of position sizing opinions, they're both still got the models at 100%. Intermediate term market posture, severely strong bull. And you look at this, I mean, the lowest score here is a 94.1. So very, very strong scores here and supported by a bullish sentiment line. Strength of the trend continues to be very strong. No change in the definition there. Hedge warning status remains 0+, normal with some cautionary aspects. In terms of special opinions, we continue to focus on the fact that the VIX is borderline acceptable, so that gives us a little bit of a cause for concern about initiating new positions for novice traders. Now, keep in mind, you could probably in this kind of market condition get away and have successful wins repeatedly with option income strategies, but as that daily squeeze finally fires, if you're not getting enough premium with your wins, you can give it all back on the 10th trade and have a series of 10 trades with 9 wins, 1 loss, but the 10th one costing you more than the 10th. And that's what gives us this asterisk as borderline acceptable, because the VIX is currently below a 12. And when that happens, we think of that as a caution and a bit of a warning about our option income strategy. So kind of keep that in mind. Now, as for cover calls and put selling, we have, for novice traders at least, it's easier to kind of set up a range of more defensive structures depending on where we are. Right now, we're relatively bullish, but if you're thinking you're getting super extended on this, it's up to you. You can get a higher ratio of lower beta positions into the mix of your portfolio. So the tricky thing is we continue to make these incremental highs, and even if we're in a late expansion part of the business cycle, there's a lot of money that often is historically to be made in late expansion cycles. So you have to remain engaged and in the market with bullish delta exposures, and here we're looking for 1 to 2 ratios of in the money to out of the money strikes and 1 to 2 ratios of low beta versus high beta. So fairly aggressive exposure at this point, but at the same time we're also mindful that it's not zero. This is not normal healthy bull market. We do have some cautionary aspects, so we got to keep the context in mind and the right balance of sensitivity and how we construct our portfolio at any one time. In terms of those specific warnings, we see we have the same 3 kind of low-grade volatility warnings we've had for some time, mostly related to this very low volatility, and it's in various forms waiting to expand, and all 3 of these are basically pointing to that expectation. In terms of trend-based, these are all very bullish, nothing really here of concern. Intermarket risk aversion indicators, still, I'm calling all these risk on, but several of these are flat on their lines, and probably I should really probably use the word neutral more often than I do with these indicators. I usually think of them as either on or off until proven otherwise. And so the fact that they're kind of sitting on top of each other until they actually clearly separate and give a signal one side or another, I don't usually make a change. But let's not make this more bullish than it really is. It's really quite neutral. In terms of sentiment, the stocks in the intermediate term are a bit elevated on the sentiment, and we see on the fear and greed index, we still continue to be in that extreme greed territory. So oftentimes when you see that, we start looking for those exhaustive moves. We start looking for those candlestick patterns that show us a reversal pattern. In terms of specific sector information, transportation, telecom, healthcare, utilities, materials are the weaker sectors, with notably telecom and utilities. Though on Friday specifically, utilities and consumer staples, two of our stubs, and our stubs being consumer staples, the staples, then treasuries, the long bond, the utilities, and then let's see, telecom, that's the other one. So now telecom, you see, actually was relatively negative down here. So a bit of a mixed signal with respect to the stubs. And frankly, with kind of a doji broad market day, that kind of makes some sense in that there wasn't a lot of clear direction being given by the marketplace on Friday to either side. In terms of our relative rotation graph, we would update this weekly. And what's notable here is the number of different segments or industry groups that are up in this upper right-hand corner. We see some of them got a little weaker in the last week or two, but still their presence in this upper section, is notable. And we'll make note of biotech, telecom, FDN. We have a position in the trade room in FDN. We certainly have some exposure to telecom. We have IYR outright. We own that ETF. So there's a number of these that we definitely have positions in, and you should be watching these for your watch list and your exposure. There's some of the best trades going right now are coming from these industry groups. Okay, I think that's probably enough for this morning. Let's go ahead and wrap this thing up. And we'll hit the disclaimers. We're a little over 20 minutes now. So hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We'll be back here tomorrow morning with the Falcon Global Market Preview. In the meantime, manage that risk, and you'll find that if you do, you'll find that everything else kind of falls into place. Good trading. Go learn something.